Welcome to All That Matters, a show about what's really worth your attention in the markets and economy today. Join hosts Michael Antonelli and Ross Mayfield as they tackle the latest headlines and answer real questions from clients.
Welcome to All That Matters with Mike and Ross. It's March 2025. There's plenty happening. There's a lot going on. Sometimes when Ross and I do these episodes, do All That Matters, not much is going on, so we want to talk about big, broader topics. But in March of 2025 right now, the stock market's going through a fair amount of volatility, and we wanted to talk about that today. Not only here, but in our written work, Ross and I also write. I write a blog called Bull and Bear. Ross writes in the markets, and he writes Five for Friday. Really good content. So we have stuff out for you if you want more than this. Make sure you reach out to your advisor and you get some of that directly to your inbox or whether they send it directly to you. So there's a couple of things we want to talk about March of 2025. We're going to talk about what's new and what's not new, okay? What's new to the world and what isn't new to the world. We'll start with what's new to the world. There's a couple things that are on our minds. First is that we have a new administration, okay? A new administration came into power. They have their own ideas of how to do global trade, alliances, everything, right? A new administration, and their primary proposal is centered around tariffs. And these tariffs, Ross, I think are what's got the market a little spooked right now, right?
Yeah, I think it's the primary cause. It's probably not the only one, but I would ID kind of three things. So one, the level and breadth of tariffs, right? Trump 1.0 was about tariffs as well, but not nearly to the extent that's being proposed today, both in terms of the countries that we're levying them in and the levels, right? Just higher levels, right. Higher taxes, all potentially bad for growth. The second one is the uncertainty, right? Both tariff policy and other policies, there's just like a big unknown. What is real, what's not, on again, off again. You read, some of the earnings reports from companies or some of the surveys of like manufacturers, and they're like, look, we could deal with tariffs or we could stomach them, but we just need to know what the rules of the game are. So I think the uncertainty is hard. And then the third one, which I think is primarily the biggest change, and we'll see if it sticks, but it's the Trump administration potentially saying that, hey, we're okay with a little economic weakness and we're okay with some stock market weakness to pursue these broader policy goals. One of the things that investors had really kind of latched onto around the first administration and coming into the second one was that they viewed the stock market and the economy as kind of a scoreboard for success. And if that's not necessarily the case anymore, then it kind of upends the framework that a lot of investors had, and it leads to the uncertainty that we're seeing today. So does that square with you, or are those kind of in the ballpark?
Those are really good points, especially that last one. I think there was always this notion that the stock market is kind of this barometer of success. And if that's not the case anymore, if it's stated that way by the administration, then that changes the way investors will view that relationship. One of the things you mentioned, Ross, is uncertainty. And I've always said this to clients, especially our advisors too. I've said that the stock market doesn't hate uncertainty. It just hates surprises. There's a big difference between the two, because without uncertainty, you would never get any stock market returns. The market, remember, never knows what's going to happen in the future. So these surprises, like 25% in Mexico, 25% in Canada, starting today. Okay, not today. Okay, back to today. I think that what's also new is this pace of news, this absolute torrential pace of what's happening. It's only, March, and like I can think of 24 things that I've had to come to grips with in the past month alone. And that pace of news, Ross, it can get exhausting at times. I sit in my office and I'll just be a little exhausted at how much is happening. And because I like to try to put pieces together, we both do, talk to clients about it. But when something new happens every hour, the stock market's just not going to like that.
Yeah, it's the omnipresence of it, right? I don't think we can even take for granted how much consumption of news, both online and via social media, has changed just since the COVID-19 pandemic. So even from the first Trump administration and the Biden administration, like this stuff is starting to happen so fast and so rampant. I mean, we were talking about this before. The last kind of big sell-off that we saw was in August, and it was around this yen carry trade. I mean, that feels like it was 10 years ago. Like who remembers that? So it's just this torrential pace of news. And for people who want to feel like they're plugged in and informed, that's a great, impulse, but it can really weigh over time, I think.
And the market's really having trouble coming to grips with that pace of news, the tariff, the on-off tariff situation, the new administration. And I'd like to remind you that if you were to look at the stock market in a post-election year, which we are in now, if you were to take the first 4 months of a post-election year, generally you see the market go sideways to down. And that makes sense to me because the market's trying to come to grips with what the new policies are and what that might mean to earnings and the economy and all those things. So I think while we're in the midst of this sell-off, let's talk about, what isn't new? What is actually the same in March of 2025 as it is every year? And I think the number one is sell-offs. And Ross and I talk a lot about this in our pieces. We are what are called evidence-based investors. And that essentially means that we like to look at history and say, what generally happens? Like, what are the odds of something happening? How often does it occur? Sell-offs, you get 5% sell-offs every single year. You get 10% sell-off basically every year. Ross just mentioned the yen carry trade. I guarantee you have no memory of the yen carry trade at all. Zero. I guarantee you don't. Right? So sell-offs are not new, Ross, right?
Yeah. I mean, the quote or the thing that I like to come back to is that sell-offs and volatility are the fee or the toll that we pay for access to the market's long-term gains, right? Like, as you mentioned earlier, if there were no uncertainty, there would be no reason the market would compound at 10, 11% a year for the last century, right? If someone came to you and promised double-digit returns every year with no downside volatility, that would be a scam. You should report them to the government or to your local agency, whatever it would be. So this is the price of long-term gains. It doesn't make it easier to stomach. Every sell-off feels different. So in theory, every time could be the big one. But I can tell you that the other thing that's very common about sell-offs, what isn't different, is that up to this moment, every sell-off that we've had until now has ended, right? Every bear market, every 10% correction, every little blip has ended up until the point that we made, a new all-time high in the stock market this year, just a couple of weeks ago. So it's worth having the context. It's worth knowing what doesn't change, but it doesn't make it any easier to deal with, right?
Yeah. And again, this sell-offs are what isn't new, right? Sell-offs will always occur, but the reasons change, right? Ross and I were talking about 5 years ago. And 5 years ago, within a week or so of now, we got hit with one of the craziest news events I've ever seen in my life, COVID, right? And while we weren't doing this series, I wish we were doing something called Good News Gazette, where we were trying to keep our clients engaged with Baird and our brand and try to bring a little happiness into their day. But that was a new reason. Now it's tariffs and a new administration. A couple years ago, it was inflation and Fed rate. There's always some reason. So that's not new, Ross.
No, and I think you're bringing up COVID, and especially on a 5-year anniversary, is really apt, because I think looking at the uncertainty that we feel today through the lens of how the COVID-19 market performed is really, really useful. So about 5 years to the day, we had what I think, and I've looked at the history, it was the craziest calendar week in market history. So if you look at, I think it was March 9th, March 12th, and March 16th, 1 week, we had 3 days where the market fell 8% or more, 3 of the worst days in the Dow's 130-year history.
Yeah.
But the important thing to remember is that, again, just like every other bear market, it ended. And the important thing to remember is it ended really quickly and well before the news looked even remotely good, well before the stimulus bill, before a vaccine, before unemployment peak. The market bottoms in March 23 of 2020 and goes on to more than double by the end of 2021. So what hasn't changed is that not only do bear markets, corrections, sell-offs end, but that if you get out at the wrong moment, it's really, really hard to get back in and reap the gains of the up markets that have always come after the fact.
Yeah, whatever we're in right now, whatever we want to call this, whatever history will label this, it will end before you feel comfortable with the news. I promise you. Whenever it bottoms, and I don't know when that is, could be a year from now, I have no idea. But whenever it ends, you will not be comfortable with the state of the world or the news, and it just will bottom that day. So then what matters, what is always the same, is your behavior is crucial. What you do is crucial. What you did when the stock market is going up is just practice. What you do when the stock market is going down is the Super Bowl. So are you up for the fact that behavior matters the most in down markets? They all have eventually ended. They were painful. They all have different reasons. And they all bottomed on days nobody expected. So that what matters is what you do right now. And again, that's why we're here, okay? We're here. And then one more thing, Ross, the same. I want to get your comment on this. I just thought about this one. Markets are powerful entities. Bond markets, equity markets, they're very powerful entities. Policymakers such as the administration or the Federal Reserve, they can have a stance for only so long. You could have a stance that I don't care about the stock market, but if it's down 20%, people vote, right? Or people get upset, and policymakers eventually have to do something. December of 2018, the Federal Reserve switched from a hawkish stance to a dovish stance, and that ended that decline. Ross, policymakers eventually have to pay attention, right?
Yeah, great call on 2018, because that I think is another really good historical comp, right? We're in the middle of a trade war. The market is selling off. The Federal Reserve has interest rates higher than the market was comfortable with. And ultimately, it ends on a policy pivot from the Fed. So who knows what it'll look like? But in March of 2020, that was the case as well. We got a lot of stimulus bills that ultimately convinced investors things were going to get better. You're right. There is just a lot of wealth tied up in the stock market via retirement accounts, and people spend based on how wealthy they feel. That's like well-studied academic literature. So this is, it's probably not the number one thing you would build a bull case on, but it's absolutely something to keep back of mind, is that eventually there's a breaking point, and policymakers mostly have to get reelected or reappointed, and they want to, please their constituents. So it's a good one to keep top of mind. It's not something we talk about a lot.
Let me just add on this quote, because we're dealing with a lot of uncertainty about the future, right? And I guess we always do, right? We just always do. That's something you need to take from us at all times. I found this great quote. It says that our anxiety does not come from thinking about the future, but from wanting to control it. And that's, I think, where most people right now will fail. They'll be like, I want to control, I don't know what's happening. I want to sell. I want to do this. I want to control this future that's uncertain to me. I think that's where most people end up failing as investors, and failing at the worst moments too. They always almost fail at the worst moments. So just remember that none of us know what the future holds. The real problem comes when you try to control an uncertain future, as opposed to building a plan and having an investment strategy that can survive all environments. Ross, if I built you a lifeboat, okay? I built you a lifeboat and I stacked it. Would you want to jump out of it when it got really choppy?
No, I would stay in that lifeboat, and I would cling for dear life.
Right? Like, that's a plan with an advisor at Baird. That's a lifeboat. That's what we essentially create. Don't jump out of lifeboats in choppy water. So Ross and I will be back next month. Hopefully things have bottomed. They're getting a little bit better, but if they're not, we'll still be here to put into context, both written and in all that matters, to help you navigate this uncertain future that we're all on the same road together. So Ross, thank you so much. And everybody, we'll see you next month.
Thanks for watching All That Matters. Opinions expressed in this episode belong solely to Mike and Ross and do not necessarily represent the opinions of Baird. This program is for informational purposes only and should not be relied upon for any investment decisions.